Okay. Good morning, everyone. So today is the second day of our deliberations on Ind AS 102, that is the share-based payment. So in the previous session, what all did we discuss? We saw the scope of this standard. We saw how it is different from the guidance note that we have earlier discussed that in the intermediate examination. We also explained that it has a very wide scope compared to the guidance note. And in addition to the guidance note, we are also having something known as, we are also covering beyond the employees' compensations. Then we went deeper to understand certain definitions, particularly from the area of employees' share-based payments, because there is a lot of calculations and there are a lot of calculations and questions that are possible from the employees' share-based payments. So we saw terms like vesting, then we saw terms like exercise period, then we saw terms like grant date, and then fair value at the grant date. And then we did the accounting of certain share-based payments. Okay, so these were the broad things that we had overall seen. And we also saw what do we understand by vesting conditions, which could be either a service condition or a performance condition. A service condition specifically refers to the fact that the employee has to remain with the organization, whereas a performance condition is basically some targets. So performance conditions, we saw that they could be non-market linked, in which case every year we estimate the probability of meeting those performance conditions. And if it is met, we accrue the expenses. If it is not met, we will extend the vesting period and then take a decision. Okay, so that is how we do the accounting. And then we also saw the accounting in the exercise period. And after the exercise period, we also saw that whatever expenses are booked, they are credited to a separate SBP reserve account, that is share-based payment reserve. This is something similar to what you used to recognize in your intermediate as the stock options outstanding account. However, your SBP reserve account goes and sits under equity, and that is why whenever we do payments in the form of stock options, we do the valuation at the fair value as at the grant date, and then no matter whatever be the changes in the fair value, they will not be modified because this is sitting under equity and not as a liability. I cannot revalue my own equity, and that is why the fair value at the grant date is expected to be a representative of the value without any further modifications to that in the future. Okay, so that is the important part. And we also saw something known as graded vesting, where you are having a phase-wise vesting that happens in respect of these options. So with that, I think we have closed whatever we had to discuss in the last session and the summary also of that. So we shall now continue and close this particular standard today. Okay. So could you revise whatever we had done, whatever we had discussed? Yes. Okay. So good morning, Devraj. Good morning, Anila, Anu. I think this is Kishore. Good morning, Hemant, Niranjan, Jeannie. Good morning. Good morning, everyone. Okay. So I had asked you to go through the theory of in some of the slides which were there. So I hope you could go through it, and I also hope you could see the questions that I asked you to go through. Okay. So with that, let us start our discussions for today. So there is just one simple question which we had not done in the last session. So we'll quickly go through that. It's just 1 to 2 minutes for us. So compute the expense to be recognized in the following case. Share options granted 25,000 share options. Vesting condition occurs if product excess market share exceeds 25% at the end of 4 years. Estimated and actual forfeiture rate 8%. So this 92% vesting. That means 8% are not expected to exercise or not expected to vest. The options are not expected to vest. Okay. Probability assessment at the grant date. Condition deemed not to be probable based on current projections. So when they came out with these options, they felt that based on the current projection, the condition is deemed not to be probable, which is okay. Grant date fair value 8 per share option. And during year 3, product X's market share is projected to be 30% at the end of 4 years. Hence, the performance condition now deemed to be probable of achievement. Okay. So now what I want you to tell me is this a service condition or is it a performance condition?
Performance.
Performance condition. Okay, now in the performance condition, is it a market link performance or a non-market link performance?
Market linked.
No, when we say market linked, it is specifically share price related. Okay, so this standard is very clear. When it talks about market linked performance, it has to be share price linked. This is not linked to any share price. This is linked to a particular product whose market share they want to enhance to 30%. So therefore, this is not having any linkage with the market price of the share, and therefore this is only a non-market linked, and therefore period on period we will have to estimate whether we are meeting those conditions or not. Are we okay with this? Yes. Okay. All right. So let us then proceed. Very simple. So number of options we had 25,000. 8% forfeiture is expected. So 92% will vest. So 23,000. Total estimated compensation cost. This is the fair value at grant date. If you read the question, this is grant date fair value rupees 8. So that comes to 1,84,000. So per year, the cost comes to 46,000. Now, initially, I think that I will not meet the vesting condition. And therefore, in years 1 and 2, I will not recognize anything since there is no probability of achieving the target. If you read the question, during year 3, it is projected to be 30%. So now in year 3, you will have to recognize expenses for the entire 3-year period. Yes, because year 1, year 2, since they were not probable, you did not recognize, but now you will recognize. So 46,000 into 3, 1,38,000 will come as a hit in the 3rd year. And final year, you will have the balance 46,000, after which the exercise is going to happen. Are we okay with this? Yes. Are we okay with this? Any doubts? Okay, perfect. Perfect. All right. So now that takes care of this part, and we are done with service and service conditions and non-market linked performance conditions. Now we come to market linked performance conditions. Okay. When I talk about market linked performance conditions, these are conditions which have a bearing on the share price or which are having a link to the share price. Okay. Now, when I talk about the share price, you tell me today I'm uh, the entity decides to give an option. Okay, let us look at this question. Okay, let us look at this question, then maybe you can understand better. Apple Limited has granted 10,000 share options to one of its directors for which he must work for the next 3 years. So this is a service condition, and the price of the share should increase by 20% over the next 3 years. The price has moved as per below details. Year 1, 22%. Year 2, 19%. Year 3, 25%. At the grant date, the fair value of the option was rupees 120. How do we recognize this transaction? Okay. Tell me, in the case of non-market linked performance condition, am I able to make an estimate, a judicious estimate of whether I meet that particular condition? Yes.
Yes, sir.
See, in all the questions, what all we saw, it is either related to the market share of a product, or it could be related to EBITDA, or it could be related to a cost control, or it could be related to an increase in the sales value. So all these are something which is dependent upon the activities within the organization, and activities within the organization are within the control of the organization, and therefore the management can make a judicious and realistic assessment of the probability of whether they will meet that condition or not. Yes or no? But in the case of market price, in the case of market price, can I really make an estimate of whether the market price in this question, for example, is going to go up by 20%? Can I make that assessment?
No, sir.
Not realistic. It's not realistic. Something like you have some untoward incident that happens in year three, and if you are thinking that probably it will vest in year four, I'll meet the condition. It's just not done. Okay, it's just not done. And therefore, what the standard says is you are not required to assess whether the market linked performance condition will be met or not. You are not required to assess. Okay. So you will not assess whether the condition will be fulfilled, and you will not estimate the vesting period. ये दोनों चीजें आप नहीं करोगे. Okay. So for a market linked performance condition, you will neither assess the possibility of meeting the condition, neither will you assess the vesting period. So then, sir, what do we do? See, what happens is we are calculating something known as fair value at grant date. Yes or no? This fair value, what did I tell you? This is based on Black and Scholes model, or this is based on binomial model, etc. Whatever is there, this is the basis for calculating the fair value. Now, this fair value is a futuristic value that is going to be computed. Okay, it is as at that date, but it also incorporates the future modifications or changes or estimates that we are having in respect of the market price of the share. Yes, because if you take a company which has a very good, excellent market price performance, okay, period on period, you're seeing a 20-25% increase over, say, the last 6 to 8 years, and the same increase is expected to happen in the future, and you have data to back it up, then this movement is captured in the fair value that we are computing using this option pricing models. And therefore, the fair value at the grant date is already having within it, or the fair value comes inbuilt with the estimate of meeting the price and the estimate of the vesting period when the price is going to be fulfilled. Yes or no? Yes? Yes? Now, there is one question that you are going to ask. Sir, with each passing year, fair value also will undergo a change. Yes, see, suppose I have an option that vests in year 4, year 1, year 2, year 3. Now, year 1, I have a fair value, and this is the fair value at the grant date. Now, I take this fair value because this considers the estimates that happen until the 4th year. Now, when I move to the 2nd year, will I have more reliable information than year 1? Bolo, will I have more reliable information than year 1? Yes, I will have more reliable information because 1 year has passed. I have gained an experience of 1 year, and I know what will happen I know better what will happen in the next 3 years compared to 1 year earlier when I was estimating what would happen in the 4 years. So, considering that, will the fair value in year 2 be the same as year 1, or will it be different? It will be different. So if it is different, do I need to change my valuation? Do I need to do a catch-up adjustment for the entries which I do? Answer is no. Answer is no. We will not do any change. We will not do any change. Year 3 will be different from year 1 and year 2 fair value. But do I make any change? Answer is no. You will not make any change. So it's a very straightforward calculation. You take the fair value at the grant date, you take the vesting period, and you do the working. That's about it. There is nothing else that you need to really do in the case of uh, in the case of market linked performance condition. Are you okay, Jeannie? Who all are there? Yes, are you okay, guys? Anu, Anila, all clear? Yes. All right. Perfect. ठीक है. Niranjan, I hope it's clear. Kishore, Hemant, I hope it's all clear. Okay. So, if I have to broadly categorize my vesting conditions, okay, changes in estimated vesting period and probability of vesting. Probability of vesting. If I have to do this working, then non-market linked and market linked performance condition. So in the case of non-market linked, tell me one thing. Are you going to evaluate year on year whether I'm meeting the condition? Yes? Yes. So consider changes at the end of each year. At the end of each year. Market linked, do not do anything. Changes to be ignored before actual vesting. Just give me a minute. Good morning. Okay. Before actual vesting. Okay. So that's about it. Very simple. No doubts. Okay. Now, sir, suppose if my actual vesting is longer than the estimated vesting period, then you will spread your employee benefit expenses over the entire vesting period, over the estimated vesting period. We have seen that in the last time. Okay, 1 year, 2 years, 3 years, we went on extending the vesting period. We went on extending the vesting period to get my calculation. Just a minute. Okay. Yeah. Now, suppose if I talk about vesting period becoming shorter than expected, then what do? I take the hit entirely in the last year, which is exactly what we had done when we did this question today morning, right? Which is exactly what we did when we saw this question. Okay. Year 1, 2, we did not take any hit. Then we thought it will hit in the third year. So we took the entire hit. Okay. And then fourth year, we took it. Okay. So that is how you are going to do the calculations. Nothing new in this second part, what I told you. It's exactly what you have been doing in each question. Okay. So now, how do I solve this particular question? Apple Limited has granted these options. Okay. So now, share price movement. Is it a market linked condition? Answer is yes. It's a market based vesting conditions. So do I have to estimate it like how I do for non-market linked? No. Its expectations are taken into consideration while calculating the fair value of the option. So even if the market condition is as required is not fulfilled, see, this is something you have to put it in red. Even if the required condition is not fulfilled, no requirement to reverse the expenses previously booked. You will not reverse those expenses. Irrespective of the outcome of the market price, in each period, you will book an amount of how many options are there? 10,000 share options to one of its directors into rupees 120 is the fair value. So this comes to how much? 12 lakhs divided by 3. So 4 lakhs per annum. This is the expense that you are going to recognize. This is the expense that you are going to recognize. Are we okay with this? Yes, are we okay with this? Anybody has any doubt? No doubts? Yes, expectations are taken into consideration. That's right, Anu. That's right. It's taken into consideration when I'm calculating the fair value. When I'm calculating the fair value. Okay, I'm not expecting when I'm doing the fair value computation initially at the grant date, that time I do the estimate. Then I don't do any further estimate. I stop it there. Okay. After that, am I considering whether I met the condition in year 2? Answer is no. Am I considering whether I met it in year 3? Answer is no. Because it's already done when I did the fair value at the grant date. When I did the computation of fair value at the grant date. Okay. Okay. So that closes this question. I hope that it is okay. All right. Now, I think we have another question. Okay. Okay. Fine. Yes. An entity issues a share-based payment. This is from your study material. Okay. This is from your study mat. An entity P issues a share-based payment plan to its employees based on the below details. 100 employees, fair value at grant date 25. Share price should reach at the end, should reach to 30 rupees. Service condition to remain in service until market condition is fulfilled. Expected completion of market condition is 4 years. Define expenses related to such share-based payment plan in each year subject to the below scenarios. If the market condition is fulfilled in year 3, so I'm not estimating. I know that at the end of year 3, the market condition is fulfilled, or if market condition is fulfilled in year 5. Okay, so very clear. Let us understand. When I gave the option, what do I expect? I expect that the condition will be fulfilled in 4 years. Number 1. Sir, but हम estimated period तो consider नहीं करते. We don't consider this period. You have to, because it requires here the employee to remain in service till the market condition is fulfilled. Are you able to understand the difference? Yes. Are you able to understand? In the previous example, there is no requirement. Okay, there is a requirement, sorry, for which he must work for the next 3 years. That is why we took this particular stand. And similarly, in this case also, employee has to remain in service for a period until the condition is fulfilled. So now I estimate that the condition is fulfilled. And when I estimate that the condition is fulfilled, it means that it's having a life of 4 years. So when I do my working, look, be very attentive about this. Okay, when I do my working, see, I am having 100 employees. How many options per employee? That is not given, so we take it as 1. Fair value at grant date is 25, and I estimate that the market condition will be fulfilled in 4 years. That is why into 1 divided by 4, 625. Have to do it because uska service condition is also linked to this. Year 2 into 2 by 4 minus what is recognized earlier. So again, that comes to 625. In year 3, have I met the condition? Yes, in year 3, have I fulfilled the condition? Anila? Yes. Have I fulfilled the condition? बोलो यार, market condition if is fulfilled in year 3. Yes.
Yes, sir.
So in year 3, हो गया काम. I don't have to do anything. So I will not do into 3 by 4 again. It's useless. I met this condition. So into 3 by 4 हम नहीं करेंगे. It will be into 3 by 3. I met the condition in the third year. Minus what is recognized in year 1, what is recognized in year 2, 1250. Year 4, will you book anything? Answer is no, because you fulfilled the conditions in year 3 itself. Are we okay with this? Yes?
Yes, sir.
Okay. All right. Coming to the next sub question, if the market condition is fulfilled in year 5. Okay. Now, what will happen? Now, what will happen? Year 1, did I fulfill the condition? Answer is no. Year 2, did I fulfill the condition? Answer is no. Year 3, did I fulfill the condition? Answer is no. Year 4, did I fulfill the condition? Answer is no. But you have to stop there. You have to stop there because now you cannot go beyond the 4th year. You cannot go beyond the 4th year, right? Why is that so, sir? Because when you are estimating the fair value at the grant date, is it estimating this movement or expected movement in the share price? Is it a market linked condition? आप पहले बताओ, is it a market linked condition?
Yes, sir.
If it is a market linked condition, did I estimate the future price movements in this fair value? Answer is yes. So in that estimation, you thought that it will be fulfilled in 4 years. You thought that it will be fulfilled in 4 years. And therefore, your calculation can be up to 4 years. It cannot go beyond the 4th year because then your fair value will be in disagreement with the calculation that you are doing. Are we able to understand? Bolo?
Yes, sir.
Yes. Jeannie, are you able to follow?
Yes, sir. I'm answering.
You are only there. Okay. Hemant, are you able to follow? Kishore, Anu? Yes, I hope you guys are able to follow. Niranjan? Okay, fine. See, it's a little tricky to explain. Okay. See, in yesterday, one of the questions, we saw that the rates, we saw that the period, we did certain modifications. Okay. It did not materialize in year 2. So 1 by 2, then 2 by 3, and then 3 by 4, and finally in the 4th year. We did one question on that manner. But here what is happening is, I have done a working of the fair value, assuming that it will be met in 4 years. If it is met within 4 years, book it entirely in the last year and close the matter. But if it is met in the 5th year or thereafter, you will not book any expenses because your fair value calculations are done based on the 4-year estimate that we had. Are we able to follow this? Yes.
Yes, sir.
Okay. So changes in estimated vesting period. Okay. So when I talk about actual vesting, okay, actual vesting period is greater than estimated vesting period. And second case could be the opposite. Actual vesting period is shorter than estimated vesting period. So if this is the case, what are you going to do if it is longer? Spread employee benefit expenses over the estimated vesting period. As determined on the grant date. As determined on the grant date. Are we okay with this? This is what we have done. And if it is shorter, spread employee benefit expenses over originally estimated vesting period before the year of actual vesting. In the last year, in our example, it was the third year, that is year of actual vesting, comma, write off entire remaining EB, write off entire remaining employee benefit expenses. Are we able to follow? Yes. So you can take a screenshot of these two, or if you are writing, you can note these two down. Market linked performance condition is done. All right. Fine. Now we come to another part, that is modifications in exercise price. I think that is the next part. That is the next one. Yes, this is done. Okay, fine. Okay. There is one COVID-19 FAQ. There is one COVID-19 FAQ. Okay. Before I get to modifications. So what had happened was, there was an entity has a number of equity settled share based payment schemes. During the last financial year 18-19, entity had granted equity shares to senior management, which is going to vest on April 30, 2021. And one of the conditions is that the market price of the entity's share is based on the market price by the end of financial year 2021. That is by 31st March 2021. But beach mein COVID happened, and because of COVID, now am I really able to estimate an event like COVID in year 2018-19? See, 2018 I gave the options, so grant date would be 1st April 18. So 1st April 18, could I foresee a black swan event like COVID-19? Is a question mark. Okay. Considering the current scenario, the entity expects to experience a severe depressed economic environment and substantial decline in its financial performance and cash flows, and therefore consequential decline in the market price of its equity shares. At 31st March 2020, the share price is much below the target price required under the employee's share-based payment scheme. How should the entity consider this development in the accounting for its equity settled share-based payments for the current year 2019-20? So how are we going to treat this? Okay. Now, market conditions shall be taken into account when estimating the fair value. The standard further states that entity shall continue to recognize the services received, provided other vesting conditions are satisfied, irrespective of whether the market condition is satisfied at each reporting date. The fair value is determined at the grant date and it is not revised subsequently. Important. Therefore, neither increase nor decrease should affect the share-based payment valuations. Okay. The entity shall recognize an amount for services received during the vesting period on the best available estimate of the number of equity instruments expected to vest, and shall revise that estimate if subsequent information indicates that number of equity instruments expected to vest differs from previous estimates based on fair value determined at the grant date. Okay. Companies with share-based payments whose vesting depends on achieving non-market performance conditions may need to revise their estimates of the instruments expected to vest, which would impact the charge in the profit and loss account. Are we able to understand what the question is saying? The question is saying that, look, you are determining the fair value at the grant date. In that, nothing is going to change. But what is going to change is the period in which you are going to fulfill this particular condition. Are you able to understand? Yes. Huma Firake is talking the same thing what we have spoken. Okay. It's talking the same thing what we have already discussed. Okay. So that is done. Okay, now coming to modifications. Or repricing of options. Okay, repricing of options. Okay, now who gives the share options to employees? कौन देता है stock options? It's the management. Yes. Management gives it to the employees. Okay. So if management gives an option, can it also modify the exercise price of that option? हाँ बिल्कुल कर सकता है, वो management है. Yes, they can definitely modify it. So when there is a modification, will it in the exercise price, will it impact my fair value of the option that I had initially computed at the grant date?
No,
Yes.
sir.
Okay, let me frame my question correctly. Suppose I had received an option with a vesting period of 4 years and I estimated the fair value initially at the grant date. Okay, number one. After 2 years, management has changed the exercise price. Listen carefully. So at the beginning of the third year, when the exercise price was modified at the beginning of the third year, will my fair value of options change because of the modification in exercise price?
Yes, sir.
Yes, Anu, is it clear? See, I'm not talking about, okay, 2-3 people said no, so let me explain. Year 1, there is a fair value at grant date. Option has a life of 4 years. Year 1 passed, year 2 passed. This is year 3 beginning. At the beginning of year 3, exercise price has changed. When? Here, at the beginning of year 3. So now, is the fair value going to change here? Hemant?
Yes.
Yes. Is this going to change, Hemant? You only tell. Yes, this will change. This will change. Why? Because I'm changing the exercise price here. Because I'm changing the exercise price. On what basis they have changed the exercise? वो management है. वो basis हो या ना हो, they can change the exercise price, right? But typically they change exercise price if your share prices are doing very well. Then they will say, why should I give it to the employee for a lower exercise price? I'll give it a higher exercise price. Or if your shares are performing worse than expected, you may even lower the exercise price. So your change in exercise price primarily is driven by the market rates of your shares. Okay, by the market rates of your share. Okay, so fair value on date of modification. This is also going to change. Now, how do I explain? So what institute tells is you calculate something known as incremental fair value. All of this is there in writing in the presentations. Okay. All of this is there. Okay. Now, incremental fair value, this has to be done on modification date. This is equal to fair value of revised plan on modification date. Okay. Fair value of revised plan on modification date minus fair value of original plan. Be careful about the date. Fair value of original plan, but on the modification date. See, understand why I'm doing this. Okay, this is not this. Okay, see. Okay. When I estimate this fair value, will there be some market estimates that would have been taken? Yes.
Yes.
There will be some market conditions. Now, will the market conditions at year 1 be the same as that at the beginning of year 3?
No.
नहीं होगा.
No, sir.
नहीं होगा. It won't be the same. Okay. So now I am modifying the option here at the beginning of year 3. Because of modification at the beginning of year 3, there will be a change in the fair value. Okay, there will be a change in the fair value. Now, you cannot subtract this fair value from this fair value directly. Sir, ऐसे क्यों बोल रहे हो? Because in this
टाइमिंग
fair,
अलग अलग है.
क्या होगा?
टाइमिंग अलग अलग है. वो ग्रांट डेट
Yes,
की है और ये
timing
मॉडिफिकेशन
अलग
डेट.
अलग है. Absolutely right. In the difference in this fair values, there is effect of change in exercise price plus effect of change in market conditions. Are you able to understand, everyone? Yes. So I have to remove this variability of change in market conditions. And because I have to remove the variability on account of change in market conditions, what will I do is I will calculate the fair value based on original conditions, but on the date of market, on the date of modification. Is it okay? Yes.
Yes, sir.
And that you will compare with the fair value of the revised plan. Yes. So in your exams, what will come is 3 things. One is fair value at the grant date. One is fair value of the revised plan on the modification date. One is fair value of original plan on the modification date. So between these three, you have to be very careful कब क्या apply करना है. Otherwise, you will go for a toss. So the incremental fair value is absolutely critical for this calculation. Is absolutely critical. It is the difference in the fair values of revised plan and original plan, but both of them are computed on the modification date. Okay. Now, tell me one thing. If fair value increases, सोच के जवाब दो. If fair value of your option increases, is it beneficial to employees or beneficial to the company?
Employees.
Employees.
Beneficial to employees. Jeannie, hope you are understanding. Okay,
Yes,
Niranjan,
sir.
hope you are understanding. Okay. So if it is beneficial to employees, can I say it will increase the expense of the company?
Yes.
Yes, sir.
Yes, sir.
ऑब्वियस सी बात है यार, सामने वाले को फायदा हो रहा है तो मेरे लिए तो खर्चा बढ़ेगा. यस. सो एनी fair value modification which is positive in this case, can I say it's beneficial to the employee?
Yes, sir.
And therefore I will consider it. अगर उल्टा होता, if it is opposite in nature, sir, original plan was beneficial, new plan is not beneficial, so therefore revised plan mein value was 100, original plan mein it was 20, so now it is minus 20. So is it beneficial to the company or is it beneficial to the employee in such a case? The modification.
Company.
It is
To the
beneficial
company.
to the company. Yes. तो अभी सोच के जवाब दो. If the option is losing its value, ये value का reduction ही तो हो गया. Yes. Original 120 था, वो गिर के 100 हो गया. Do you think employee will really exercise this option in the future?
No.
If the employee does not exercise this option in the future, is there any meaning in computing this minus 20?
No.
No.
No, sir.
सेंस ही नहीं बनता है यार. वो ऑप्शन है ही नहीं. That option is now converted into an impossibility. वो पहले ऑप्शन था. अभी तुमने इतना बेहुदा परफॉर्मेंस किया है कि कोई तुम्हारे कंपनी का शेयर खरीदना ही नहीं चाहता. तुम्हारे एम्प्लॉय तो कतई नहीं खरीदेंगे. दे विल नॉट बाई योर शेयर बिकॉज यू हैव नॉट परफॉर्म द वे यू शुड हैव परफॉर्म्ड. सो योर ऑप्शन is a kora kagas. It's an empty piece of paper which has no value in the market, certainly not for your employees. So sum total में इसका incremental value will be taken as nil. आप कुछ नहीं लोगे. It is a big shunya, a big zero. Is it okay? Yes. So do not make the mistake of taking it as negative and booking an employee benefit expense reversal. वो रिवर्सल नहीं होगा. आपका एम्प्लॉय भी कंपनी में रह के he would have definitely earned that much of intelligence to know when he has to exercise, when he has to not exercise. ठीक है. So that's about modification concept. Okay. So modification concept क्या होगा? Basically the entity is ending up repricing these options, that is changing the exercise price. Now, if the exercise price changes, then what the entity has to do is it has to perform two calculations of fair values. The first one is fair value of the revised plan on the date of modification, number one. The second one is fair value of the original plan on the date of modification. If the fair value of revised plan is more, that means the incremental fair value is positive, then we will see what we have to do. But if it is negative, the incremental fair value is going to be zero. The incremental fair value is going to be zero. तो अभी हम अकाउंटिंग ट्रीटमेंट कैसे करेंगे? हाउ डू आई हैंडल द अकाउंटिंग ट्रीटमेंट? What the standard tells is original plan. Sir, original plan कौन सा है? The one that was given to you at the grant date. उसका accounting, follow it as it is. Just follow that accounting as it is. Do not modify anything. So in this case, it's a 4-year plan. They have changed the option at the beginning of year 3. You will not do anything for that adjustment in the original plan. Original plan जो year 1 में दिया था, उसी को चलाओ 4 साल तक. You continue that accounting for 4 years. तो sir, modification का impact will now come. Okay. Modification. Now in this modification will be regarded as a new plan. Is it okay? And the incremental fair value spread over remaining vesting period. Are we able to understand this? Yes. Very simple. Any doubts? No doubts. Okay. So we are required. Just a minute. There will be a small power outage, but it won't affect our working. So let us continue. You may see a small fluctuation in the lights, but that's it. Okay. All right, fine. Okay. So have we understood the treatment? New exercise price will come, Hemant, when the options get exercised. We are still in the vesting period. These 4 years are the vesting period. After this, when the options get exercised, that will happen on the basis of the fresh exercise price. Are we okay? Yes. Anybody has any doubts? Please ask. Anybody has any doubts? Please ask. Okay. Boys and girls, Hemant, Anila clear, Anu, Pooja, all clear. Perfect. Devraj, hope it's clear. Yes. All right. Fine. Now, so if we look at the presentation, recognize services received measured at grant date fair value of equity instruments. This is what the original plan will continue as it is. Number 1. Recognize effects of modification that increase the total fair value of the arrangement or are otherwise beneficial to the employee. See, standards never give the easy language. Okay, वो घुमा फिरा के बात करते हैं because that is how it has to be. Otherwise, where will we come in the picture, right? So, and recognize effects of modification that increase the total fair value means what? Fair value of revised plan on date of modification minus fair value of fair value of original plan on the date of modification. If this is positive, then I will recognize the effects of that modification. How will I recognize? I will spread that over the remaining vesting period. So this is original plan. This is the modified plan, which will be treated as a fresh plan from the date of modification. So types of modification, one is which is beneficial to the employee. So that could be either increase in fair value or increase in number of equity instruments, modification of vesting conditions to the benefit of the employees. I will be doing this accounting prospectively. That is obvious because from date of modification, if I have to do the accounting, we call it as prospective accounting. Okay? If it is not beneficial to employees, decrease in fair value, ignore, don't do anything. Decrease in number of equity instruments granted, we are treating it as cancellation. So we'll come to cancellation later. Modification of vesting conditions to the detriment of employees, ignore. Am I okay with this? Yes. So let us start the question. Let us start this question. Very, very important question. Okay. Marathon INC. Do I do it here? I think it's okay. Yeah. We can see the solution here and question here. Marathon INC issued 150 share options to each of its 1000 employees subject to service condition of 3 years. Okay. Fair value of option given was calculated at 129. What is this 129? Can you please tell me? Which of the three fair values it is? Original fair value at the grant date. Original, absolutely. Okay. At the grant date. Okay. Below are the details and activities related to the SBP plan. Year 1, 35 employees left. Further 60 are expected to leave. Share options are repriced as market value of shares has fallen as the fair value fell to 50 rupees. After repricing, they are now worth rupees 80. Hence, expense is expected to increase by 30. Okay. Too many descriptions. What is 50? What is 50?
Non-beneficial to
I'm not even coming to beneficial, non-beneficial. आप सिर्फ इतना बताओ, what is this 50? Sentence पूरा पढ़ो.
Modified fair value.
fair value change नहीं होना.
Is it fair value of original plan or fair value of revised plan?
Revised plan.
Read
So
the
fair
question.
value of original plan on a modification date.
That's right. See, share options repriced. Now, why did this repricing happen? Because the market value of the shares has fallen, and because of the market value falling, the fair value fell to rupees 50. Fair value fell मतलब fair value अपने आप गिर गया, कंपनी ने कुछ किया ही नहीं. Okay, the management did not do a fair value calculation. So the fair value went from 129 to 50. So rupees 50 is fair value of original plan on modification date. Yes, are we okay? अभी कंपनी ने कुछ एक्शन लिया नहीं है. Yes, company has not taken any action now. After repricing, now they are talking, after repricing, they are now worth rupees 80. So what is this 80?
Revised plan
Revised
की
plan.
Revised plan fair value.
Yes, fair value of revised plan on modification
date.
date. Is everybody clear what is 129, what is 50, what is 80?
Yes, sir.
And
Yes,
what is
sir.
this 30?
Incremental, the
Yes.
80
difference.
minus 50. Okay, this 30 is nothing but 80 minus 50. है कि नहीं?
Yes, sir.
वही हो गया. If they had to not give 30, could you calculate it by yourself?
Yes, sir.
Yes,
Yes.
sir.
129 Hemant is the fair value of original plan on grant date. fair value of original plan on grant date. Are these things okay? See, if we are having a problem in interpreting this, we'll have a problem solving the question. If we are absolutely clear on interpreting this, then solving the question, I'm not at all worried because I know you guys, then it's just arithmetic. Okay? All clear. Okay. Year 2, 30 employees left, further 36 employees expected to leave, and year 3, 39 employees left. So how will the modification be accounted? How will the modification be accounted? Okay, so very simple. So first one, what is the rule? What does the standard say? Original plan, will you change anything? Nothing. It will continue as it is. जैसे आप हर every calculation करते हो, that will continue as it is. The incremental fair value calculation will be treated as a fresh plan and accounted for prospectively. So, चलिए, let us have a look. So, I have 1,000 employees. 35 left in year 1 and 60 are expected to leave. 35 minus 60. So 905. Shares per employee 150. Fair value of shares on the grant date is 129. So if you multiply 905 into 150 into 29, quickly do that. Do you get this 58, 37, 250?
Yes, sir.
Yes, 58 lakh 37,250. All right. Now, in the next year, what is happening? Another 30 employees left. So, 35 plus 30, 65 employees left. Alternatively, what you can do is you can take it as 965 minus 30. Okay. Both are acceptable. Answers will be the same. Okay. And a further 36 employees expected to leave. Further 36 expected to leave. 899. So 150, 129. Okay. So 899 into 150 into 129 into 2 by 3. Am I getting 1 crore 50, 97, 100?
Yes.
Yes. Yes or no, everyone? Hemant? Yes. So this is for the cumulative 2 years minus what is booked earlier. 58 lakh 37,250. Tell me one thing. Have I given any impact of modification here?
No.
No, not given. Okay. Last one. So how many actually left? Year 2, 30 employees left. Year 3, 39 employees left. Okay. 39 employees left. So ultimately, you will get 896 employees into 150 options into 129. Does it come to 173, 37, 600? Yes.
Yes.
Minus what is booked in the first 2 years. 1 crore 15, 97, 100. Have we understood? Yes. And the expense for the third year is 57 lakh 40,500. So there are no doubts here. There are no doubts. Okay. ठीक है, आगे बढ़ते हैं. सर क्वेश्चन खत्म हो गया नहीं. One part is over. Original plan you have taken to the conclusion. Now the story will come on modification. Okay. Modification. How many employees are expected to avail? 899. Yes. Into 150 into incremental fair value 30. over the remaining vesting period, which is 2 years. So into 1 by 2. So 20,22,750. Are we okay with this?
Yes, sir.
Yes, sir.
In the next year, actually 896 employees are going to avail this into 150 shares per employee into 30. It is 40,32,000. This should not be 3 by 3. This should be 2 by 2. Answer वही आएगा, but 3 by 3 is wrong. It should be 2 by 2. Okay, that is my mistake when I was writing the solution. Okay. Are you okay with this?
Yes, sir.
Minus what was recognized in the previous year, 20,22,750. So net is 20,09,250. Have you understood?
Yes.
Hemant, did you follow? Devraj, did you follow? Okay, no problem, Anu. Thank you. See you. Okay, all right. Office timings. Yes. All right. Perfect. Okay. So let us proceed. So that closes modification. That closes modifications. Anybody has anything else? Nothing else. No further doubts. Okay. आगे बढ़ते हैं. Let us proceed further. Okay. Now, the next one is, this is done. Okay. The next one is cancellation of options. Okay. Cancellation of options. Okay. Who gives the options to employees? Management. If management gives the employees, can it cancel what is given?
As it was an option, it does not create any obligation, so it can cancel.
Yes, absolutely right. Cancel कर सकता है. But tell me one thing. Cancellation is so easy. You have promised employees to give something and now you are taking it back. Yes? Yes or no?
Yes, sir.
Yes, sir.
Cancellation, is it something that I give you this piece of paper and this piece of paper I say I will give you after 2 years, and after 1 year I come, I'm not going to give you. I'm keeping this piece of paper with myself. Is it so simple? Answer is no.
No, sir.
Employees will tell, हम तो सोच के बैठे थे कि आप 2 साल बाद हमें दोगे options. Otherwise, we would have left the organization 1 year back only. It is because you promised us, we are now we stayed with you. But now you are not giving us the options. So what the standard says, so typically when you are withdrawing the option, generally there will be a compensation also that will be paid. There will be a compensation also that will be paid, a cash compensation. आप equity shares नहीं दोगे, but you will compensate the employees in cash. Obviously, they have waited for you. Suppose your option was 5 years. Somebody stayed for 4. Somebody wants to really avail the options. So he works for 4.5 years. And just before it becomes due, management आपके सामने प्रकट होके बोलते हैं हम आपको ऑप्शन नहीं देंगे. Then that employee will lose all his sanity probably, because he would have gotten so many good opportunities elsewhere, right? So therefore, when I cancel the option, typically I will also come out with a cash compensation. वो common होता है. Okay. Now the next one is how do I do the accounting? Okay. So typically a cancellation of options is treated as immediate vesting. सर कैंसलेशन आप बोल रहे हो इमीडिएट वेस्टिंग, तो जब कैंसल हो गया तो वेस्टिंग कैसे होगा? See, if you had not cancelled, these options would have vested in the employees. Yes or no?
Yes.
The employees are doing the services. Yes or no?
Yes, sir.
Yes,
So
sir.
if they are doing the services, you are having a problem to give the options. Employee तो बेचारा काम कर ही रहा है. Yes. And for all that I know, these employees would have lived till the end of the options to exercise them. Yes.
Yes, sir.
So on a conservative basis, give me an honest opinion. Can I say that these employees would be there till the end of the vesting period so that the options would be exercised? Think from a conservative approach now. Don't go realistic. Conservatively, आप क्या सोचोगे? Today, I'm cancelling the options and X employees are there in whom this will vest after 3 years. X may say 20 will go, 30 will go. I don't really care. But today's date, are there X employees who are waiting for these options?
No. Probably they will go.
They don't know about cancellation. They don't know about the cancellation. Okay, let me draw a timeline. Okay, timelines are best for explaining. Okay, so year 1, the option has a tenure of 5 years. You have given the option on year 1. Year 3, you tell them, look, boss, I'm not going to give you these options. So let us assume on this date, 85 employees were there. 85 employees were there, right? Now, these 85 employees, what is conservative to think? Will
They
these
would leave the
85...
organization.
Wait. If there is no cancellation, what is conservative? You will think that all these 85 employees will live for 5 years in the organization, take the options and then exit. Yes or no?
Yes. Yes.
Yes,
That
sir.
is the maximum degree of conservatism which is possible. And the maximum degree of optimism is what? Sir, कोई exercise ही नहीं करेगा. ये सारे लोग छोड़ के चले जाएंगे. Now, what is realistic in a case of cancellation? Cancellation के केस में you have to think the worst because you are doing the worst. अच्छा सीधी सी बात बताओ. Tell me one thing. When year 3, 85 employees are there, will all these 85 employees come to the organization to claim compensation? See, if I cancel the options here and promise a compensation in cash, do you think 10 employees who were supposed to leave, they will not come and only 75 employees will come? Come on.
No, sir, they will also come,
All
na?
85 will come. All 85 will come to you. Yes. And
Yes.
therefore, cancellation should be treated as immediate vesting. So when I say immediate vesting, I don't mean they get options. I basically am trying to say that the entire remaining year's cost जो है, you book it entirely in the 3rd year itself. Okay? Because for all that I know, these employees would have served and claimed the options. अभी ऑप्शन नहीं मिलेंगे, they are going to get some compensation. So, sir, we will take the hit of this 5-year vesting employee benefit expenses plus the compensation also. Answer is no. इतना आसान नहीं है. There is a manner of computing for the compensation. But till now, am I okay with the first step of cancellation?
Yes, sir.
Yes. So whatever is the remaining expense that needs to be recognized over the remaining 2 years, I will book it entirely in the 3rd year. Is it okay? Yes.
Yes, sir.
It is kind of saying my vesting period has gone from 5 years to 3 years. मैंने उसको options I promised them after 5 years, but I said I'm going to give them in 3 years as if it is like that. It's not that, but as if it is like that. Now coming to compensation. Employees will not leave you like that. They will demand a compensation. And compensation will be in cash. Compensation will be in cash. Okay. Now, this cash compensation will have two components. Up to fair value on the date of cancellation. On the date of cancellation. And balance. That is beyond the fair value. Excess if any. Okay. So up to fair value. See, in this, when I'm recording the expenses, what is the entry that I pass, beta? Employee benefit expense account debit to SBP reserve. Yes or no? Yes?
Yes, sir.
So I have already booked the entire expenses and it is now sitting happily in my SBP reserve account. So up to the fair value on the date of cancellation, whatever compensation I pay, I'll not take the hit to the P&L. I will take this hit to the SBP reserve. So adjust from SBP reserve to the extent possible. To the extent possible. Are you able to follow? Sir, मैंने P&L hit ले लिया है. I have taken the hit in the P&L when I did the immediate vesting. So I will again not take a hit to the P&L for the fair value compensation, whatever I'm doing. Yes or no? So anything extra that I'm paying beyond the fair value, that amount you will take it to the P&L as compensation paid on cancellation of stock option scheme. Are we able to follow? Yes. Total cash compensation less fair value on date of cancellation. So that gives you how much? Some amount is going to come. This will be loss on cancellation transferred to P&L. Have you understood, everyone? Yes?
Yes, sir.
Okay. The yes is not convincing. Anila, Pooja, Niranjan, Hemant.
Sir, clear, sir.
Yes, sir, clear.
Clear. Okay. Fair value on the date of cancellation. Up to that amount, whatever cash compensation you are going to give. See, on this date, there will be a fair value. That fair value, if you pay in cash, effectively, that is the amount what is sitting in your SBP reserve, right? You have done the fair valuation and then you have done the accrual of expenses. So effectively, up to the fair value on the date of cancellation, you meet it from the SBP reserve. Okay. And if the variation is too high, obviously it won't be the entire amount from SBP reserve. SBP reserve kam pad jayega. In that case, what you are going to do is you will take it as excess fair value, take the hit to the P&L. Anything over and above that, you take it to the P&L. Is it okay? And finally, if there is any amount left in SBP reserve, transfer it to retained earnings. Okay. Balance amount left in SBP reserve to be transferred to retained earnings. To be transferred to retained earnings. Are we okay with this? I'm sorry for a little background disturbance. Some work is happening. Okay. Yes.
Sir,
ठीक है? Yes.
this compensation is any lump sum amount, or this is based on the vesting period, the amount they given to the employees?
See, typically वो क्या होगा ना, there will be some basis for determining the compensation. See, one is obviously at least the vesting period का जो खर्चा है, that at least has to go to the employees in the form of cash. Otherwise,
Yes,
employees will say, why do I have to even work here if I'm not even getting what is expected of me? Okay, so labor laws in that sense are pretty fair to the employees. So you will definitely get that. But beyond that, also you will be probably getting something, because if you had received the shares, probably you would have earned more in the form of capital appreciation or dividends. तो फेयर
yes,
वैल्यू से थोड़ा ज्यादा मिल सकता है आपको. इट्स अ लंप सम. Okay, there will be a lump sum payment. Yes.
because you have said na, the remaining SBP reserve will go to any retained earnings.
So
That's
in
the
rare cases, अगर आप fair value तक के भी पैसे नहीं देते,
yes,
yes,
sir. Yes, yes,
then that case there will be balance left in SBP reserve that will be transferred to retained earnings. That is very rare. Okay.
yes.
So suppose your company is not at all doing well,
Hmm.
then
Yes.
आप क्या करोगे? आप बोलोगे एम्प्लॉइज को, देखो भाई, इवन इफ यू गेट द शेयर्स इट्स अ वेस्ट.
जितना
ओके,
है उतने
तो जितना है ले लो, मैं आपको कैश दे दूंगा थोड़ा सा. यू बी हैप्पी विद दिस कैश, डू नॉट वेट टिल द एंड, यू आर फ्री टू लीव और एग्जिट द प्लान,
yes,
and I
sir.
will pay you. Okay, so that depends. Okay, fine. Have you
Thank you.
noted this down? Anybody wants to note this down can note this down. Okay. Note this. Okay, fine. So then let's proceed. Hemant, I hope it's clear to you. Anila, hope it's clear.
Yes, sir.
Okay, I hope it's clear to everyone. Okay, all right. So let's proceed to do the question. Cancellation. ठीक है. Anara Fertilizers issued 2000 share options to its 10 directors for an exercise price of 100. The directors are required to stay with the company for the next 3 years. Fair value of option estimated is 130. Expected number of directors to vest the option is 8. So out of 10, 8 are expected to vest. 2 will be not available at the time of exercise. During the year 2, there was a crisis in the company and management decided to cancel the scheme immediately. Okay. The original scheme tenure was 3 years. Okay. It was estimated further as below. Fair value of option at the time of cancellation was 90. Market price on the date of cancellation was 99. There was a compensation which was paid to directors and only 9 were currently in employment. At the time of cancellation of such a scheme, it was agreed to pay an amount of 95 per option to each of the 9 directors. How would the cancellation be accounted or recorded? Okay, fine. So first one, year 1. Year 1, do I know about cancellation? I don't know about cancellation. Okay. I don't know about cancellation. So I will do a regular accounting. So when I talk about regular accounting, it will be 2000 options into 8 employees into 130 into 1 by 3. Have you understood the workings? Yes. 8 directors expected to vest. 130 is the fair value of options per option. 2,000 options per director. So total is 20 lakh 80, but this is for a 3-year period. So you will book only 1/3. So 6,93,333. Are we okay with this? Yes. Year 2, there is a cancellation. So cancellation hoga. So 9 directors, because 9 people are there on the date of cancellation. Take the same thing, 130, 2,000, 23 lakh 40. Don't make this 2 by 3. Again, mistake from my side. This will be 2 by 2. Okay. Because they are expected to immediately vest. Calculation is correct, but only annotation was wrong. So 23 lakh 40 into 2 by 2, immediately it's getting vested minus what is booked earlier. So in the second year, you are going to recognize the expense of 16,46,667. Till now, is it okay? Yes. Now, what is the cash compensation they are giving? 95 is what the question said. Yeah, 95 per option. Okay. So 9 directors into 2,000 into 95, 17 lakh 10,000 is what is the compensation that is going to be given. Okay. But will I meet entire 17 lakh 10,000 out of SBP reserve? Answer is no. Only up to the fair value on the date of cancellation you can meet. So 9 directors, 2,000 into fair value at the date of cancellation, that is 90, 16 lakh 20. So you have paid an excess amount of 90,000, which will be taken to the P&L, Am I okay with this?
Yes, sir.
So journal entries are very simple. Employee benefit expense account debit 6,93,333 to share-based payments reserved first year. Second year, immediate vesting 16,46,667. Then you are making payment of compensation. So 1620 from SBP reserve, 17 lakh 10 total. So this is a balancing figure which is transferred to P&L. And finally, there is a balance left in SBP reserve. You can transfer that to retained earnings. See, transferring to retained earnings, though the institute explicitly does not give in some of its questions, institute is very clear that it will be closed and transferred to retained earnings. Because it's very obvious, if the options does not exist, how can I have SBP reserve in my books? Yes or no? So in some cases, even if you pass this entry and do the transfer, you will be awarded full marks. Okay. And that's the right thing to do. Okay. That's the right thing that you will have to do. Okay. So that's overall your cancellation. That's overall your cancellation. Yes. Any doubts? Any doubts so far? No doubts. So pretty much clear. So modification is understood. Cancellation is also understood. Okay, perfect. All right. So this is done. Okay. Now, okay. Okay. I want you to do this for homework. Okay. Again, this is a good question. This is modification of options. You can see employees covered 600, 60 options per employee. 3 years is the vesting condition, employment service condition. Nominal value is face value. Exercise price is 125. Fair value on grant date is 14. Vesting period 3 years. Exercise period 1 year. Position at the end of year 1, 30 for the employees have left, 70 expected to leave. Exercise price reduced to 120. Fair value of original option is 13. Fair value of option at reduced exercise price is 15. Vesting date for modified option is the same as original option. Position as at the end of year 2, as at the end of year 3, as at the end of year 4. Compute expense to be recognized in each year and also show the journal entries. So, year 1 original plan, year 2 original plus modified plan, year 3 original plus modified plan, because that goes up till the vesting period. Year 4 there is the exercise that happens. Okay, so this is typically a very nice question that integrates your modification of the plan. Okay, but modification of the plan in the earlier question, it was a simple straightforward accounting. Here what is happening is they have given till the end of the vesting period, both the plans are progressing. So can you do this for homework? It's nothing new. I have not given anything new. Okay, can you try this for homework, everyone?
Yes, sir.
कुछ है नहीं इसमें, it's exactly what we have done earlier. Okay, nothing is new. That's why I read the question to make you understand that nothing is new. So I'm leaving this for homework. This is based on the earlier syllabus study module. Okay, it's based on earlier syllabus study module. Okay, fine. Now, okay, so let us then come to Hindu. Okay, this one additional question is there. Then we come on to okay, fine. Hinduja Limited grants 100 non-vested shares to each of its 1,000 employees that vest after 5 years of service. The grant date fair value is rupees 10. Based on historical employee turnover rates, Hinduja estimates that 200 employees will terminate prior to completion of the 5th year. At the beginning of year 3, Hinduja accelerates the vesting of all awards. So accelerates means it is saying, I promised I'll give you after 5, but I'll give you after 4 years only. So is it beneficial to the employees?
Yes, sir.
Yes, I told you, modification of option can mean modification of fair value, modification of conditions also, vesting service conditions also. So in this case, it's beneficial. So I would be doing 1 by 5, 2 by 5, 3 by 5. But okay, so at the beginning of year 3 itself, he said I will do it as 4. So it will be 1/5 in the first year, 2/5 in the second year, 3/4 in the third year, and fourth year entirely everything will be closed. Okay, rather than the original 5-year service period. As a result of the acceleration, Hinduja now expects that only 150 employees will forfeit their awards. Compute the expense that the company should recognize in each of the years. Yes, so simple. So originally I thought 100 employees will fulfill, but in year 3 when I modify, it will be 150 only expected to retire, so 850. So number of options per employee. 5 years is the vesting period for first two. Then I made it as 4 years. So 1/5, 2/5, then it becomes 3/4, and last year is the entire amount. Yes or no? So this is what is the expense that you are going to recognize each year. Any doubt so far, anyone? Yes? Yes? No doubts?
No, sir.
Okay, so easy to do. You can try it out. Okay, all right. This RTP question pertains to modification, so you can go through this. Okay, they have given the modifications, then they have explained what they intend to do, which is basically in line with what the standard also has prescribed. So just for knowledge purposes, read that, but it's exactly what we are doing. Company requested you to suggest the suitable accounting treatment as on 31st March 20x3. Okay, All right. So this I leave it with you for homework. It's simple. Okay. All right. So with this, we come to an end of employees share settled plan. Any doubts? Anyone in this? Share-based payments for employees, share settled plans. Okay. Equity settled plans. So we started off with the original discussions. We saw the definitions of the grant date, measurement date, vesting period, exercise period. We saw the journal entries. Then we saw service conditions, market linked performance condition, non-market linked performance condition. We saw modification of options, and we saw cancellation of options. Yes, is it all clear? Yes. Okay, fine, no doubts. Okay. See, the only reason I keep asking much is because these are scoring topics. Okay. See, there could be some potential standards which are complex in nature and where a twist is always possible. Okay, I'm not saying that you will not be able to do, but these standards are like guaranteed standards. इसमें accounting है ही क्या, गिन के तो 2-3 entries हमने पढ़े हैं. We have studied only 2 to 3 entries. Employee benefit to SBP reserve, SBP reserve account debit to equity share capital to securities premium. यही दो entries में we have spent our life since last class and today's class. Apart from that, we have not done anything. Okay. So accounting wise, it's very simple. But what is important is the calculation mechanism. And calculation mechanism till now, most often it is just pure arithmetical logic that we are applying and a little bit of common sense. Okay. So I don't want you guys to go wrong in this particular chapter in your examination. Okay. These are all, when institute comes out with these questions in the examination, you should immediately put it in your pocket and say my 6 marks or 8 marks or 10 marks is secured. That is how you should have your preparation levels for these small standards. Okay. All right. Coming to the next topic. You want a break or we continue? Break. All right. So we take a break. We take a 5-minute break. It's 8:37. Okay, we meet at 8:45. Okay, we have to do cash settled share-based payments, then non-employee share-based payments, and finally, we will look at some miscellaneous topics and wind up the session. Okay. All right. So break till 8:45. Okay. All. Yes. Thanks. coming to the next topic, that is cash settled share based payment transactions. Okay. So, as I told you, this topic is share based payment. It's not only equity settled. Okay. So, any payment that is made on the basis of share price or in the form of equity shares is covered. So that is why we have a separate section called as cash settled share based payment transactions. Okay. So what do you mean by cash settled? So in your intermediate, you would have studied something known as SARS. Do you remember stock appreciation rights? Yes. Do you remember stock appreciation rights? So stock appreciation rights means what? It is an instrument that is given, and in lieu of that instrument, the instrument holder is entitled to receive cash. The instrument holder is entitled to receive cash. And once the instrument holder, and how is that cash value determined? How is that cash value determined? Well, that will be based on the fair value movements of your share price. That will be based on the fair value movements in your share price. But unlike ESOPs में क्या होता था? Unlike stock options, you had an option to only get equity shares in the entity. So the entity only had an obligation to deliver equity shares. Are you able to follow? It was an option only to deliver equity shares under the equity settled share based payment transaction. But now what we are looking at is the entity has an obligation to deliver cash. Okay, so these SBPTs represent an obligation to deliver cash. And any instrument that is an obligation to deliver cash becomes a liability. It becomes a liability. Okay. Earlier case, it was obligated to issue equity instruments. It was obligated to issue equity instruments. That is why your SBP reserve would go and sit under other equity. But this case, your stock appreciation rights value will go and sit under liabilities in the balance sheet. It will go and sit under liabilities in the balance sheet. Yes. Are we okay with the basic difference? Yes. Are we okay with the basic difference? Yes. Now, coming to accounting. So what happens is, at each balance sheet date, you will be given the fair value. At each balance sheet date, you will be given the fair value. Why are you given the fair value? Because that represents the cash that you are required to deliver. So, sir, every year end, should I do a remeasurement to bring my instruments at fair value? Answer is yes. In equity settled share based payment transactions, you would not do a settlement. You would not do a true up fair value measurement at the end of each reporting date. Sir, why did we not do? Because I cannot remeasure my own equity. I cannot remeasure my own equity. So that is why I would record a fair value at grant date, and it would appear at that value until the options get vested, exercised, and then the SBP reserve would be transferred to retained earnings at the end of the life of the options. Are we able to follow? Yes. Are you able to follow? Anybody has any doubts? But in case of cash settled, you have an obligation to deliver cash. That is why you will have to do a fair valuation at the end of each reporting date. Okay. I have a question from Ram Sharma. Can a company issue any other security instead of shares? And whether the accounting treatment will be the same if they issue their own market linked debentures? It will not come under Ind AS 102, Ram. Okay, because Ind AS 102 is share based payments. Okay, when I'm issuing any instrument other than shares, then it is not covered under this. So that will go under your, if you are issuing your own debentures, that means you are probably ending up creating a liability. 1 minute, just a minute. Okay, I hope the screen is visible now. Okay, all right, fine. So that will end up issuing debentures. So that will not be covered under the standard. Those will be covered under your financial instruments chapters. Okay. So accounting treatment, everything will be done in line with those standards. Okay. All right. Fine. Initial measurement shall be at the fair value of the liability. The remeasurement will happen at the end of each reporting period, and any changes in fair value shall be recognized in the profit and loss for the period. Okay, very simple. Coming to the next one, expenditure to be spread over vesting period, same like equity settled share-based payment transactions. Vesting conditions also same, there is no change. So we have done the overall treatment, okay, already. So there is nothing new that needs to be done. Okay. So equity settled SBPT, reference to fair value granted in the case of modification. Liability for cash settled SBPT as at the modification date is derecognized and difference is taken to P&L. So same thing. Okay. Next. All right. So I leave these examples for homework. These are just theory. Okay. All right. Let us now look at a question. Okay. What if company issues convertible debentures? What if a company issues convertible debentures? Again, you are issued, will it be equity share, convertible at whose option? Okay. Is it mandatorily convertible, compulsorily convertible? All those things are going to come. Okay. So, it's not a simple one-liner question. When I'm issuing convertible debentures, I still have an option to deliver cash. So I'm going to discuss one specific instrument right now after I complete stock appreciation rights, which is what you call as equity settled share-based payments with a cash alternative. So that we are going to discuss. Maybe to some extent, it is going to resolve your issue. Okay. All right. Fine. Coming to illustration 2, XYZ issued 10,000 share appreciation rights that vest immediately in its employees, that vest immediately. Okay. So there is no vesting period as such. These are already vested. Already they have worked, and this has entitled them to that. The SARs will be settled in cash. Using an option pricing model, it is estimated that fair value is 95. It can be exercised anytime up to 31st March 20x3. That means 1, 2, 3, 3-year time. At the end of the period on March X1, expected that 95% will exercise. 92% will exercise at the end of next year. Finally, 89% will be vested only at the end of the third year. Fair values at the end of each period are given below. Pass the journal entries. Okay. So, simple calculation. Fair value at the time of vesting, that is grant date. It is not vesting over a period. They have immediately vested. Okay. So fair value 9,50,000. So employee benefit expense account debit to SBP liability 9,50,000. So this is the first set of entries, 9,50,000. All right. Next one. Employee benefits expense. Okay. Now we come to the next one. At the end of each year, I will do a fair value measurement, and any gap which is there, we will take it to the P&L and adjust the value. So I'm expecting 95% to fulfill the conditions. Fair value of option at the end of year 1 is 112. So number of options expected to vest is 95% into 10,000 into 112. So that is the total value, 10,64. This is based on the closing value. Already recognized previously is 9,50. This is booked on 1st April. So amount to be expensed in the current year is 1,14,000. This is basically the movement in the fair value. So 1,14,000. Next, we move on to the next one. 112 becomes 109. And now I expect 92% to exercise. So 92% into 109 into 10,000. So that comes to 10,02,800 minus what is booked earlier, 10,64. So differential 61,200 is a reversal. So that will be SBP liability account debit to employee benefit expense account. So this is a reversal. It's a reversal. Why? Because fair value has come down. Coming to the last one, 114. So 89% into 10,000 into 114, 10,14 minus what is booked till the previous period, 10,02. So 11,800 is what we are going to recognize. And finally, when you are paying them, it will be SBP liability account debit to bank. That will be 10,14,600. Okay. So have you understood stock appreciation rights? Yes. Jeannie, Hemant, Niranjan, Pooja, Anila. Yes. All clear?
Yes, sir.
ठीक है, perfect. ये हो गया. So I leave this question for homework. Same to same है. This is similar to May 2018. It has come for 10 marks. Therefore, these questions come for 10 marks. That's right. So Ram, in this question, the SAR vested immediately. That's why the entry is passed on 1st April 20x0. Otherwise, like how in equity settled we used to do, na 1/3 or 2/3 or 3/3, however it is, depending on the tenure, depending on the vesting period, how many employees expected to vest, what is the vesting period. If that was given, it will vest over the next 4 years. Then I will multiply it by 1/4 and do the posting at the end of the year. Okay? But now in this case, it's immediately vested. That is why they have already performed the service. So I'm taking the hit entirely now and booking the liability. Okay? All right. So that takes care of this question. This is the same question. I'm leaving it for homework. It's exactly the same question, nothing new. Okay. This also is the same, only thing. Okay. 1 second. This vests immediately. Okay. Now, for your clarification, Ram, we will look at this question so that you will be convinced on how to do the accounting. Okay. All right. I'm leaving that question for homework and then, okay. Is this solution there? Okay. Question 8. 73, 72, 74, 75. Okay, okay. No worries. We can pick this up from the study module itself. Because I don't have the luxury of time if I sit to solve. Okay. So this is the question. Okay. Question 8. Question 8. Okay. P Limited granted P Limited granted 400 stock appreciation rights to 75 employees, each to 75 employees on 1st April with a fair value of 200. The terms of the award require the employee to provide service for 4 years in order to earn the award. So here you will have to work for 4 years. The fair value of each SAR at the reporting date is as follows: 210, 20, 215, 218. What would be the difference if at the end of second year of service, P modifies the terms to require only 3 years? So let us quickly run through it. So first one, original without modification, 400 options, 75 employees, 210. So 400 into 75 into 210, but this is for the first year out of 4. So into 1 by 4, 15,75,000. Then the next one is the price is increasing from 210 to 220. So 220 into 400 into 75 into 2 by 4, 15,75,000 minus 15,75,000 previously recognized. So that comes to 17,25,000. Then we move on to the next one, that is 215 is your fair value. So 400 into 75 into 215 into 3 by 4 minus what is booked earlier, 33 lakhs. And lastly, fourth year, the value is 218. So 218 into 400 into 75 into 4 by 4 minus what is booked earlier. So 48 lakh 37,500, 17 lakh 2,500. So this is how you are going to do the calculations. Okay. So Ram, for your immediately previous question, will it be passed on year end? Yes. You can see all these entries are posted at the end of each year. All the entries posted at the end of each year. Okay. All right. Coming next to the questions. What would be the difference if at the end of second year, the terms are modified to require only 3 years of service? So if that is the case, then year 1 will be 15,75,000. Year 2, I will change this to 2 by 3. See, earlier it was 1 by 4. Now it becomes 2 by 3. And then it becomes 3 by 3. So these figures, this remains the same, 15,75,000, but these figures are undergoing a change. These figures are undergoing a change. Okay. So that is done. So fair value, is it my stock market price? Answer is not necessarily. This is again done using an option pricing model where you get the fair value of the share appreciation, right? Okay. All right. So that takes care of question 8. That takes care of question 8. Next. Okay, fine. Any doubts? Jeannie, in the question, Hemant, anybody has any doubts? No doubts. Who else is there? Pooja, Anila, all clear? Hemant, sab clear hai beta? Yes. All right, fine. Okay, I want you to try this for homework. This is going to be settlement also or exercise also. So at the end, you will be making the payment in cash. So that's the only change that is there. So you can pursue this particular question for homework. 12, 8, 13, 12. I'm leaving this with you guys for homework. Please do it. Okay, solutions are anyways there. You can have a check. Okay. Modification is to be taken at the year end before passing the SAR entry. Which modification impact, Ram? So this is done, given for homework. This also you can try it out for homework. Okay. All right. So that is okay. So change in terms. Yes, before passing the SAR entry, you can take the modification impact and then do a fair valuation entry. Okay. Yes. So that is done. Next. All right. Let us move on to the next one. Last 2-3 topics are left. Nothing that is majorly difficult. Okay. So you guys have the energy to continue, right? Star, everyone understood? Yes. Okay. Now coming to the next one. That is a compounded instrument. See, we saw one instrument, equity settled share-based payment transactions. We saw the second instrument, that is cash settled share-based payment transactions. But sir, can we get something like a hybrid instrument? What do you mean by hybrid instrument? In one instrument only, there is the option to get equity shares. If I don't want equity shares, I want cash. Are there such instruments? Answer is yes. There are such instruments. And we call that as share-based payment transactions with cash alternatives. We call that as SBPTs with cash alternatives. Basically, the entity will give the employee the choice of settlement. The entity will give the employee the choice of settlement. The instrument will ask the employee, do you want cash or do you want shares? Okay. And then the accounting will happen in the manner of a compound financial instrument. Are we okay? Yes. So now let us see how to do the accounting. Let us see how to do the accounting. So one thing is, how do I treat this? Okay. So the entire instrument comprises of two components. One is a debt component where the entity can demand cash from the issuer. Okay. The other can be equity component where the counterparty wants equity shares and not cash. Okay. So the entire transaction is treated as a cash settled plan. Conservative. Plus there is an equity alternative. Is it okay? Yes. So that is how you are going to treat this particular instrument. You tell me one thing. How do we explain? Okay, let us do it with the help of a question. Okay, let us do it with the help of a question. Then, we shall understand better. Okay. Okay, fine. Let's do the question. Okay. With a question, I can explain more things and you can also understand better. Okay. All right. On 1st January 20X1, ABC Limited gives options to its key management personnel to take either cash equivalent to 1,000 shares or 1,500 shares. So two things. It is cash equivalent to 1000 shares, number one, or 1500 shares, number two. So either of the two can be taken. The minimum service requirement is 2 years and shares being taken must be kept for 3 years. Okay. So service requirement is 2 and shares are coming in with a lock-in period. They are coming in with a lock-in period. So fair value of the shares are as follows. Share alternative fair value 102 with restrictions. Grant date fair value 113. Fair value on December X1, December X2. Employees exercise the cash option at the end of 20X2. Pass the journal entries. Pass the journal entries. All right. So now, what the standard tells, we will account for this. We will account for this as if it is a cash settled plan, but there is an equity option on top of that. Okay, so let us see how it goes. So entity can take 1500 shares. Yes, entity can take 1500 shares, and those shares are restrictive. Restrictive matlab they must be kept for 3 years. You have a holding restriction of 3 years. So 1500 into 102 into 102. Yes. Are we able to understand?
Yes, sir.
So that comes to 1,53,000. So if the employee wants to take shares, it will be 1,53,000. All right. Now, if he does not want to take shares, grant date fair value, this is SAR. That is stock appreciation rights. Okay. So this date's fair value is 1000 into rupees 113. 1,13,000. So this comes to 40. What is this 40,000? Either I had to get equity, in which case the value would be 1,53,000, or I had to get cash, in which the case the value would be 1,13,000. So this excess of 40,000, this is the value of equity option. This is the value of equity option. So far, is it clear? So far, is it clear? Yes. Anila, is it clear? Hemant, is it clear? Pooja, is it clear? Ram, is it clear? Yes. No more answers. Only Jenny has confirmed. Okay. Fine. All right. Now, let us understand what is the next step. So we got this, we got this, we got this. This is obviously after subtracting. So 40,000. Now, cash option, what did the standard say? Treat it as a cash settled alternative with an equity option. Cash settled instrument with an equity alternative. So number of options. How much is it for cash? Cash equivalent to 1000 shares. So that is 1000 into 120 into 1 by 2. So 60,000. 60,000. Next. 1000 revised fair value 132 into 2 by 2, 132 minus 60. So that comes to 72,000. And here it is 60,000. Is it okay so far? Yes. So far, is it okay?
Yes, sir.
All right. And I have an equity option also. 40,000. This equity option, we shall spread it on a straight line basis. That is 20,000 each period. All right. So 80,000. Yes, 92,000. This 40 is basically spread over the 2-year tenure. Okay, so now when I do the accounting, employee benefits expense account debit, 60 plus 2, 80,000. To SBP liability account, to share-based payment reserve account. To share-based payment reserve account. Next. X2 total expenses is 92,000, 20,000 in equity, 72,000 in cash, 72,000 in the form of a liability. Okay. All right. Next. SBP account debit to bank, share-based payment liability 1,32,000. SBP reserve 40,000. Okay. So that closes your journal entries. Anybody has any doubt here? Please ask. Give me a minute. At the end of the tenure, 1,32,000 will be settled in cash and SBP reserve is transferred to retained earnings. This is obviously under the impression that the cash option is exercised. Okay. So when your cash option gets exercised, they will take the cash and whatever you have accumulated in your SBP reserve, you will transfer it to retained earnings and close the SBP reserve account. Okay. Now, let us move on to the next one. Next one, calculations are similar, but I have gone one step further and we have also done the settlement, assuming it could be a cash settlement or assuming it could be an equity settlement. So both the settlement terms are done. So we'll just quickly run through this question. This is also a slightly important one. Okay, this has, I presume this has come in one of our RTPs or exams. Okay, same features. Tata Industries issued a share-based option to one of its KMPs, which can be exercised either in cash or in equity. Number of cash settled shares 74,000. Service condition 3 years. Equity settled shares 90,000. Service 3 years and restriction to sell for 2 years. Equity price with a restriction of sale for 2 years 115. Fair value at grant date 135. Fair value at the end of each year 138, 140, 147. Pass the journal entries. Okay. So I am having fair value of a share with a restrictive clause 115, for which I have allotted 90,000 shares. So 115 into 90,000, 1 crore 3,50,000. This is the shares. Assuming that this is the entire share settlement that the employee will go for, he will have to get 1 crore 3,50,000. Fair value of a share at the grant date 135. Fair value, number of cash settled share 74,000. This is not share, this has to be SAR 74,000. So 74,000 into 135. Okay. Again, this will be SAR. So 74,000 into 135, 99 lakh 90. So fair value of equity component will be 3 lakh 60. That is basically 1 crore 3 lakh 50,000 minus 99 lakh 90,000. Okay. So this is the basic treatment. Now, if I have to do the accounting, first one, treat it as why is this getting stopped every time? Okay. So 1 crore 3 lakh 50 minus 99 lakh 93 lakh 60. Now, what is the requirement? Treat it as a cash settled alternative, and then we will see at the time of settlement. Why am I treating as a cash settled alternative? So that conservatively I take the hit to my P&L. Tomorrow, sudden I treat it as an equity and put it in SBP reserve, and suddenly employee demands cash. Then in that case, the liability will be a very big hit. Then in that case, the liability will be a huge hit to the P&L, and therefore the standard says on a conservative basis, you will have to take the hit in the P&L, and then at the time of settlement, we will take a decision. At the time of settlement, we will take a decision on what needs to be done. Okay. So based on that, let us look at the calculation. This is the same what we had done earlier also. So now, number of options 74,000. 138 is the fair value at the end of year 1. So 1 crore 2 lakh 12 into 1 by 3, 34 lakh 4,000. Equity option of 3 lakh 60,000. This we spread it equally over the 3 years. And then same calculations, but here if you see, we are taking the fair value because these are all liability settled. These are all liabilities. So I'm doing a remeasurement also. So 2/3 and 3/3 minus what I have booked earlier. So my total expense for the period is these amounts. So first case, employee benefit expense account debit, 35 lakh 24,000, out of which 1 lakh 20 is going to SBP reserves. Remaining amount is your SBP liability. For the second year also, 1 lakh 20 goes to SBP reserve, balance goes to liability. And for the third case also, 1 lakh 20 goes to SBP reserve, balance will go to share-based payment liability. So this is something that is common. Okay. Now we come to settlement. This is where things get interesting. Let us assume that the employee opts for cash settlement. Cash settlement hai, so he will get 147. So the entry will be SBP liability 74,000 into 147, 1 crore 8 lakh 78,000 to bank. Settlement is happening in the form of a payment. Now, if it happens in the form of cash, something is wrong in this. I'm losing my connection every time. So sorry, this is causing a lot of disturbance. Okay. All right. And finally, what is there in SBP reserve? Since the options are now settled, we will transfer it to liability. We will transfer it to liability. We will transfer it to retained earnings. SBP reserve account debit to retained earnings. Suppose the employees demand equity shares. Suppose they demand equity shares, then I will issue them equity shares. They will not get any cash. So in that case, SBP reserve 3,60,000 will definitely get closed, but SBP liability also will get closed, and both of them will be moving towards equity share capital, because here you are doing the adjustment in the form of equity shares. Are we okay with this settlement? Are we okay with this settlement? Anybody has any doubts? Yes? Oh, Jeannie, clear? Hemant has confirmed. Okay. Anila is not responding today. Just she has left. Pooja cleared. Okay, she has given a thumbs up. Okay, Niranjan, hope it's understood. All right, fine. So this is your SBPTs with a cash alternative. Okay, share-based payment transactions with a cash settled alternative. Ram Sharma, have you understood? Yes. Who is the other? Dev Raj. Hope you have also understood. Okay. All right. Fine. So I leave this one question for homework. That is, this we did. I'm going to leave a couple of questions with you for homework. You can do this for homework, and then you can do this for homework. Try it out. It's exactly the same. So there is no change. In fact, it's even smaller in terms of the figures. Okay. So do this for homework. Nothing is going to hold you. All right. Fine. And then let us take the last one or two topics before we wind up. Okay. All right. Now, my screen, why is it not visible? Is my screen visible? Yeah,
Now
it has. Now it has come. Okay, fine. There is a lag. There is a lag. I don't know why there is a lag. One minute, just a minute. एक्सक्यूज मी ये अशोक जी ये स्क्रीन शेयरिंग नहीं हो पा रहा है, डिसेबल करके बता रहा है. ओके. ओके, मैं अभी चेक करता हूँ. आ गया लगता है ना अभी. ओके, स्क्रीन इज विजिबल बट थोड़ा सा फिर भी लैग है. लाइव में लैग क्यों होना है? ओके फाइन, ठीक है, आ गया. Okay, so coming to one of the last and interesting topics, SBPTs among group entities. Okay. Now, what happens in a group entity? I explained this yesterday also in the last session that suppose a listed parent company, unlisted subsidiary, you have an issue, all that. So how do we treat it? So let us take a case of a parent company which is listed, and I have unlisted subsidiary S Limited. Okay. I have employees of S who are providing their services to the unlisted subsidiary. They are employees of S. But if employees of subsidiary get shares of subsidiary, then employees bolenge, what do I do with this? I cannot sell it to anybody because these are not marketable securities, right? So they will tell, subsidiary will tell, I'm not going to give you my shares. I'm going to give you the listed parent company shares. H limited shares I'm going to give. So employees are very happy. Okay, at least I got a marketable security. Is this a share-based payment transaction? Answer is yes. Because we are getting the group transactions. Okay, the group shares. But now the problem is very different. Now the problem is very much complicated. Subsidiary S Limited will pass the entry employee benefit expenses account debit. That debit is going to happen. What will it credit? It cannot credit equity shares because it is not issuing equity shares. It is not issuing equity shares. The who is issuing the equity shares? It is the parent company which is issuing the equity shares. Okay. So now when I talk about parent company issuing equity shares, the parent company will credit equity share capital. But when the parent company will credit the share capital, what will the parent company debit? Something to think about. Okay. Coming to the reverse case, your employees are working for the parent. Your employees are working for the listed parent company. Okay. And the subsidiary of the shares are going to be issued. So H Limited will record employee benefit expenses. S Limited will record equity share capital. But in this case, what will be the corresponding entries that need to be passed? What will be the corresponding entries that need to be passed? So therefore, what the standard tells is you will have to evaluate substance over form. You will have to evaluate substance over form. So if it is the first case where subsidiaries employees are providing services to the subsidiary and parent is giving the equity shares, that payment is nothing but a capital contribution from the parent that will go and sit under other equity. In the parent's books, it will be regarded as an investment in the subsidiary. It will be treated as an investment in the subsidiary. Alternatively, when I look at H Limited's employees are working and parent subsidiary is issuing the equity shares. It is a payment made by subsidiary to the parent company. So in that case, it will be regarded as a dividend that is being paid. It will be regarded as a dividend that is being paid. Okay. So that's all that is there on the SBPTs among the group entities. Okay. It is all that is being paid. It will be regarded as it will be regarded as a dividend that is being paid. Is it okay? Have you understood? Otherwise, why will a parent and subsidiary enter into transaction with each other? Hai. So this is the understanding that you can take from here. This is the understanding that you can take from here. Any doubts so far? Anybody has any doubts? Yes. So in this case, listed subsidiary, unlisted parent. So Losing the connection every time. That's the last topic is creating some connection issues. So this case, dividend by subsidiary to parent. And in this case, it is capital contribution by parent to subsidiary.
Sir, the screen is not visible for the document over which you are writing.
अच्छा ओके आएगा वो थोड़ा धीरे है I don't know what is the problem. It will come. Just give it some time. Okay. There is some lag. I'm having some network issue on my screen. Okay. 1 second. But did you understand the concept?
Yes, sir.
Today. Just a minute. Okay, is it visible now?
Yes, sir.
Acha. Okay. Yeah. So in the first case, employee working for the subsidiary, parent is issuing the shares. So this will be regarded as capital contribution by parent to subsidiary. Okay, capital contribution by parent to subsidiary. In the second case, employees working for the parent, shares issued by subsidiary. This will be regarded as dividend by subsidiary to parent. So H Limited will pass the entry employee benefit expense account debit to dividend from subsidiary. And subsidiary will pass dividend to parent account debit to equity share capital. Okay, so that is the entry which will be passed. In this case, the subsidiary will pass employee benefit expense account debit to capital contribution. This is a separate line item which will go and sit under other equity in the balance sheet of the subsidiary. H Limited will pass the entry investment in subsidiary account debit to equity share capital. This will go and sit under its investments. Okay, so that is the treatment which you are going to do for SBPTs among group entities. By large, these are the disclosures. What is the scope of agreement, terms and conditions of each type of share-based payment plans, weighted average price, average share price of exercised options, valuation method, impacts on the P&L and the balance sheet. These are largely the items which we are going to disclose. Okay, let me check if any major item is left. I don't think anything is left. We did cash settled SPPTs, we did SPPTs with cash alternatives, SPPTs among group entities, equity settled SPPTs. Okay, disclosures. Okay, just one small clarification. Just one small clarification. So far, whatever we have studied majorly was on employee share-based payments. Sir, what will be the treatment in the case of vendors who provide goods or services against which we are issuing shares? In that case, the transaction will be measured at the fair value of the goods or services that are coming in. At the fair value of the goods or services coming in. You remember I told you measurement date is different for both of these transactions. In the case of employee benefits, it will be the grant date. In the case of other suppliers like services or goods or capital equipment, it will be the date when there is an actual receipt of goods or services. And the valuation will be based on the fair value of those goods or services which you are receiving. Sir, employee के केस में हम क्यों नहीं कर सकते ऐसा? Because how are you going to fair value an employee services? When I'm debiting employee benefit expenses, I need to attribute a value to that. How am I going to attribute a value to what the employee is going to give? So that is why I take the fair value at the grant date. That is why I take the fair value at the grant date as the basis of doing my calculations. Okay. So with that, I presume everything is done. We have done all the workings, all the details here. All sheets are shared, cash alternatives discussed, group share-based payments are done, modification, cancellations, disclosure, exclusions also is done. Yeah. With that, I think performance conditions, repricing. Yeah, that's about it. We have covered almost all the items. Nothing else is left for me to discuss. Achha, at the end of the small clarification for stock appreciation rights, any stock appreciation rights which is unexercised, the balance will be transferred to the P&L. Any ESOP, equity settled, SBP reserve balance, transfer it to retained earnings. This is the only 2-3 things which are there. Okay. All right. So that is done. And then we are done with everything. Yes. Anybody has any questions now? You can ask from me. Yes. Or anything you would like to let me know, or anything you expect further in this topic. Yes. We have done ample questions. There is no dearth of questions which we have solved. Go through the remaining questions as a homework. It's all calculation is the same. You can understand the workings. We have done ample workings. Okay. So anybody has anything to ask or tell? Ginny? Yes. Perfect. Thank you. And Niranjan, anything you have? Pooja, anything, any queries? No queries?
No queries, sir.
Okay, perfect. So with that, I think we are done. I mean, I have no questions on the chat portal also. Ram Sharma, hope it's clear. Devraj, hope it's clear. Yes. All right. So that's it. Okay, fine. Then I'm done from my end. I have nothing else left to cover in this topic as such. Okay, we have covered everything. We can close the session if that is the case. Okay. PP liability, yeah, it's all done. Let's wait for a couple of minutes for some queries that may come. Perfect. Hemant, I hope he's understood. Okay. ठीक है. Okay, fine. That's it. Then we can wind up the session. Okay.
Thank you, sir.
Thank you. Sir, session close कर सकते हैं.
Thank you, sir.
Thank you. Thank you. Thank you. Thanks. Thank you.